Hi, this is Matthew Cratter from Trader University, and today we're going to talk about covered calls on steroids. That's what I'm calling it. And what I'm going to show you in this video is how you can make $2,900 in your account, even if you have less than $10,000 in your trading account. So let's get started. We're going to go to Yahoo Finance. You can just type that into Google. And when we get here, we're going to go over here where it says quote lookup, and we're going to enter KO. We're going to be looking at Coca-Cola today. And we're going to click the Options tab right here. And then we're going to scroll down and we're going to look at the August 2017 calls. So we're going to be buying the stock to do a covered call position. We'll be buying the stock right around here. We'll call it $42.99. We're going to buy 1,000 shares of Coke at $42.99. And this will cost, let me show you this is the hard way to do it if you need a lot of money in your account. But in this version, we'll buy 1,000 shares. It'll cost us about $43,000 after a commission. And we're going to sell 10 of the August calls at $1.21 each. So those are right here. Here's the bid. It's about 1.21, 1.2. We're going to sell those at $1.21. And when we do this, we're going to pocket about $1,200. And these calls expire in August of this year. So while we're holding the stock, we're also going to collect another $370 in dividends, which will be paid to us in June. So our total return on this is $1,210, the money we collected from the covered calls, plus $370 from the dividends, divided by our capital deployed, which was about $43,000. We'll be making about 3.67% between now, it's mid-April, between now and August. Now, this is not too impressive or exciting. So what we're going to do instead, I'm going to show you how to lever this up and basically do covered calls on steroids by selling puts instead. So let's go back here, and instead of looking at the calls, you can see the calls are listed first. We're going to go down here and look at the puts. So we're going to look at the same strike price, which is pretty much right at the money, the 43s. And they're currently bid at $1.45 and $1.49. So let's go back here. So let's say we can sell the puts right here at $1.40, $1.45. Now, we sold only 10 calls when we were doing this position. We're going to do double the amount and try to crank up our return here. Now, you can see that when we're selling puts, we're actually not going to own the stock. And so the reason the premium we're collecting from selling the puts is a little bit higher, this dividend payment that we would have got holding the stock is sort of embedded in there. So basically, we can sell 20 puts of 20 of the August 2017, 43 strike puts, sell them at $1.45. We'll collect $2,900. And you can see already that's a lot more money than the $1,200 or the $1,500 we'd collected before. But now let's think about how much money we actually need in our account to do this. Before we needed almost $43,000. In this case, let's assume that the lowest Coke can go is $40 a share between now and August. Now, you can run your own scenario analysis on this. You can say, well, maybe I think Coke's going to go to 35, or I think it's just going to go to 41. I'm just picking a round number here to make it easy. So let's say the lowest we think Coke can go between now and the expiration of these puts is 40. So if the stock is going to go down to 40, we're going to need to have, the stock's currently at about 43. And if it goes down to 40, we're going to have another 3 points, plus the premium. Now these puts are trading at the money, so most of this is just time premium. So I'm just trying to estimate stuff here. So let's assume we're going to need to have about 445, 3 plus 145, or 445 times 20 times 100, or about $8,900 in our account. This is assuming the lowest we think Coke can go over this period is to 40. So now let's recalculate our return. We're pocketing $2,900 before commissions. And in all these calculations, I've left out commissions, but they're fairly minimal. $10 here, $10 there. It's not going to affect these numbers very much, assuming you're using a discount broker. $2,900 we pocket. We've deployed capital. We have cash in our account of $8,900. So now we're talking about some real returns here. Now we're talking about 32% return over just 4 months. Now that's pretty crazy, and maybe that's a little too aggressive for many of us. So in that case, let's just give ourselves more breathing room, and let's double the amount of money we want to have in our account. So instead of $8,900, we're going to have $18,000 in the account. Doing that, our return on selling these puts is still going to be 16% for these 4 months. So that's really quite a spectacular return. So the purpose of this exercise was to basically show you how you can, instead of doing covered calls, you can do puts. And you take on more risk in exchange for more return. And you can basically choose how much leverage to use. So for example, we were only selling 10 calls. When we do it with puts, we could have just done 10 puts and remained much more unlevered. We decided to really crank it up. If you want to be really aggressive, you could sell 30 puts, 40 puts. Really depends on your own risk tolerance. Now, if you want to learn more about these strategies, I suggest that you go read my book, Covered Calls Made Easy, on Amazon. You can just type in Covered Calls Made Easy, or you can, on the Amazon website, or you can click in the link below in the description notes. And be sure to subscribe to my video. I'm going to be putting out more of these. And also let me know in the comments what kind of videos you'd like me to make in the future. Thanks for listening. I'll see you in the next video.